What's up, guys? Welcome back to the channel. This week, we will be kicking off our channel with our first episode of Weekly Watchlist. So, this is basically going to be a series where we detail our most interesting plays of the week, what we think could be potential buys this week, and interesting things to watch. So, without further ado, I'm going to have Tyson get us started here with our first stock.
So starting out, obviously we're a new channel and we want to reach a lot of new investors. So we're going to start off with a weekly watch list, just like some obvious stocks that you really can't miss on. So first one we want to talk about is obviously Apple, and they actually have some big news coming up. So on July 30th, the stock was sitting at 385. And I know that a lot of new investors might not have a lot of money to invest, and we also have the option of fractional trading. So what we can do is, even if you only have 20, 30 bucks and you want to dump it into a stock, you can put it into Apple and you can still see growth. So what I was saying on July 30th is the stock was sitting at 385. And on July 30th, they announced that they're going to be splitting their stocks from 1 to 4. So if you own one stock at $400 and it splits down for 4 different stocks, you're now going to own 4 at $100. Yeah. Simple math. Obviously, it's not too hard to keep track of. But here's the thing. So since announcing on July 30th, it's been, 4 weeks?
Yeah.
And the stock price has already rose to 505 at the
jumping.
End of market hours today.
People are jumping.
So what a lot of people are saying is that there might not be a lot of room for growth. The problem is it's Apple. There's always going to be room for growth.
Yeah.
With the stock splitting, it gives opportunity for investors like ourselves who might not be rolling with a lot of cash. We can invest more on those $100 stocks and feel like we got more out of each share, because it feels more fulfilling to own one share than a half a share or a quarter of a share. That's just how it is.
Yeah.
So what we're looking at is we've already seen a giant growth in the stock market over the past 4 weeks, and on August 31st, that stock's going to split, and we might not see that growth happen over the next week. So right now might be a decent time to buy. With that, we see that a lot more people are going to be able to buy because it's going to be a cheaper stock. People are going to feel more comfortable. So that stock price is going to raise again.
Yeah.
Not to mention that Apple is already a powerhouse in the stock market. It's something that all these other companies follow. They want to be like, and they're going to make you money. So if you're worried about stocks that are, I don't know, kind of iffy,
speculative,
put some fractional shares into Apple and let that money grow over the next few weeks.
Yeah, it's really a retirement stock, guys. It's not going to, I mean, this is one that you can literally buy and you don't even have to look at it for years. Like, I would honestly prefer buying into Apple rather than an index ETF like the SPY, S&P 500, the whole market index. Like, it's that much of a powerhouse. People are just not going to stop buying it.
No, absolutely not. It does have a high price-earnings ratio, which a lot of people have different views on that.
It's Apple.
So normally, the higher it is, they're saying that the company's overvalued. The lower it is, it's like an undervalued company, but then investors might not be confident in it. So there's a lot of different ways to feel out how the the PER ratio works.
Yeah.
The PE ratio.
I think that was a good point.
It's a little bit overvalued right now because of the split, but it's still going to make you money, and it just means that everyone's confident in what Apple's doing.
Exactly, and that's essentially why he brought that up is because you're going to pay the premium for a company that is going to perform and going to give you the results. So
exactly.
And with a company like this, I mean, if you just take a look at their balance sheet, it's just ridiculous, guys. They're just stacking cash. They kind of remind me of Microsoft in this case. They've tremendously built, so much cash on hand that they could probably survive 2 or 3 virus scenarios at this point. And the extra value they've added here is with the earnings per share. If we just take a look and go back, 5 years, their earnings per share has grown dollars, like a couple dollars each year, which is like unheard of for some of these smaller cap companies. They're like, and they're still doing it, even in the trillions of dollars here now. We've seen them hit all-time highs after the split news, and which kind of baffles me because fundamentally nothing's changing, but people here split, and all of a sudden it's like everybody wants to jump in, and we've seen this happen with Tesla as well now too. But I mean, guys, our pick for this week and our mentality on Apple was that you really can't miss. So, I mean, if you don't have any, now is a good time, in our opinion, our personal opinion. This is not advice, but, we're not financial advisors. But as you can see, I'm holding a little bit in my portfolio on the screen, and I will continue to add to this position long term. So.
Yeah, absolutely. The other thing that you need to be watching out for with Apple is try and get in before like iPhones and stuff come out. So yearly, there's going to be bumps whenever the iPhones come out because they're the most popular phone, especially in America. And you see that at least a small jump every year. So if you are looking to put in some fractional shares, say you got $30, you want to put it into Apple, you know that the new iPhones are coming out in a month or two, leave that money in there. That money might jump up. The money that you put in there might jump from 30 to 50 to 60. And if you feel like you want to use that money elsewhere, you can take that money out, move it around, and you've made yourself a couple of bucks. You know what I mean? So not everything is going to be a hold. Obviously, with Apple, you can hold for a long time, and you'll feel comfortable about where your money is. But if you ever need to take money out, you're going to get a gain before you bring that money out and put it somewhere else.
Yep, and I think that pretty much covers it. I mean, really, this is an easy one to cover. If we just look at their 5-year growth, it can explain itself. I mean, it's ridiculous. This isn't going to be a stock. It's not going to be a stock you're going to 10x your money on. I think we both know that. But, they might throw you a surprise or a curveball, and you might end up doubling it from here on out. Who says they can't hit $4 trillion? I mean, at the rate we're going, everybody freaked out and was like, no, $2 trillion market cap, no way. That's not going to happen. And they proved them wrong off a stock split. So not even a new iPhone cycle did that. So it's pretty crazy. Anyways, moving on to our next stock here, we have Mastercard. All right, guys, so the second stock we have for you today is Mastercard. Why we believe Mastercard could be a potential buy or a stock to watch is because of their commanding position in the e-commerce space. And what we mean by this is that, yes, when you're shopping online, most of the time you're using a card. In fact, when you're going into a store, most of the time you're still using a card. And now with the pandemic going around, we believe this is a good buy moving forward. They've shown incredible growth over the last 5 years and seem to show no signs of stopping, as we see here on the 5-year graph. The company itself, I think honestly, if we're speaking truthfully here, you can't really go wrong with Visa or MasterCard. But the reason that we picked MasterCard is because of the smaller market cap and what it can offer that Visa maybe can't going forward, which is more growth. So being smaller investors, we're looking for the maximum growth potential out of the stock. And a nice thing to note with this one, as well as Apple, is the fact that they both do give out small dividends, very minuscule dividends, but it's still something, which is nice. And the reason we decided to include it this week is because, as we can see here on the graph, in February it was trading around $344, and we have just now reached recovery level prices of $347 to $351. So it's still setting 52-week highs even after the pandemic has come out. And even though MasterCard is not a really distant number 2 to Visa, it is number 2, and that's important to note. But we do believe where the company's headed long term, they can catch up and, if not surpass Visa, and maybe hit a $1 trillion market cap moving forward. So
yeah, I mean, even though they're number 2, it's not like they're not handling a lot of money. In 2019, they handled $6.5 trillion worth of payment.
A lot of cash.
It's not like it's not getting used. It's getting used. You know what I mean? There's plenty of people like my bank actually switched from Visa to MasterCard I think it was a year and a half ago. Mm-hmm. So I'm seeing it more often because, like, I remember in 2016 with the Olympics, like, Visa was the sponsor, but now more and more I'm not seeing as much Visa on TV or through ads on anything else. I'm seeing a lot of MasterCard. I've seen it everywhere. Yeah. So for me, that's a good sign. That means other people are seeing it, they're using it, they're thinking about it. And that's ultimately going to help us out in the long term if we invest now.
Yeah. And I think that's a very good point. And as we can see here, it's trading at, Robinhood says right now it's trading at 47 times price to earnings ratio. So the market thinks that it is going to get a bump in price as well. So the market also believes that MasterCard will continue to grow. It's been around for a long time. I don't think it's going anywhere. This one's another no-brainer kind of stock. We'll save the most speculative for last. But it's important to note with this type of company, not like Apple, they might even be more stable than Apple because they're not really as product heavy, and the business model that MasterCard has actually allows for greater profit margins. So things like service charges, fees, and other things associated like that, and all their credit card services will allow them to keep good margins moving forward. So this one's really just a no-brainer for us guys. Like I said, watch it, invest in it if you feel comfortable. Obviously, do your own due diligence, but we will continue to look at these two mentioned so far. So without further ado, on to our next one, Penn National.
So for our final stock on the weekly watch list, we will be looking at Penn National Gaming. So for me, I like to invest in a lot of companies, whether I'm either passionate about the company or passionate about what they're involved in. So for me, I'm a big sports nut. I like it a lot. I follow a lot of different teams, a lot of different sports. Penn National Gaming, over this past year, has completely blown up. They announced a partnership with Barstool earlier this year, and their stock price has shot up from around 15 to 20, depending on the week, up to $38. And then, of course, everything happening in the world, especially in the U.S., dropped back off, as well as 99% of all the other companies in the U.S. But aside from that, they're already way above their 52-week high, sitting at around $54 at the end of the day today.
Huge return.
With that, they partnered with a company called Barstool Sports, a big sports media company that has been taking over the podcast and YouTube space. They really just push Penn to what they are now.
Yeah. I mean, this company, you were seeing like a $3 to $4 billion market cap before the announcement. And then when they announced the partnership with Barstool Sports, I mean, we're seeing almost double that, which is ridiculous. And they're only holding like 36% equity in the company, with maybe some room, don't quote me, maybe some room to buy more of Barstool Sports as well. Not sure on the complete details on that, but that sounds promising to an investor, obviously, like myself and you holding shares in the company, you know? So.
Absolutely. Some things to look out for. Obviously, with everything that's going on, sports have been kind of iffy. So we're seeing 100% growth, 110% growth on today from their last high before the pandemic had hit our nation. So that's huge. And considering during that time, we haven't had any sports. So they're a sports gambling company, and their stock prices have grown 100%
without
no
sports.
Yeah. Another thing that I suggest, obviously I can't advise you to do anything, something that I'm looking to is in September they're supposed to release their own sports gambling app. Now this is going to be huge because it's so much easier to gamble on your phone, obviously, than it is to go to a sports book. Mm-hmm. Other things that we're having to look out for are actually some positives, because sports gambling is not legal in every state. And that has held restrictions on a lot of sports gambling companies in the past. But coming out of the pandemic, a lot of states, like I think it's 46 out of the 50, have already discussed it and want to put plans in place to have sports books and have sports gambling be legalized in the U.S. so they can make tax money for the state. So there's a huge upside for the states to decide to increase sports gambling, as well as huge upsides for companies like Penn National, who can take this smaller market cap company and raise it a lot higher. Yeah. So with this app coming in September, that's right around the time that football starts, which is their highest, most profitable season.
Yep. And keep in mind, guys,
sports gambling.
Not to cut you off, but we do have the NBA Finals approaching. We have the
Yes, we
NBA
do.
Finals approaching. We have a starting NFL season, and an app that is yet to be released, and we've already seen this crazy growth. So I think it's safe to say we're bullish on the company long term because
Yeah,
we
absolutely.
have yet to see what they're able to provide, and it's already grown this much. We're already invested, to say the least. So, I mean, do your own research, obviously, but this is where we think you should be focusing your eyes this week. So, if you don't have anything else you want to say, I mean...
No, I mean, this is something that I'm going to be looking at for the next week to see where it goes. So,
All right,
see what
guys.
everyone else thinks.
All right, without further ado, that'll wrap up our first episode of Weekly Watchlist. This is these are all the stocks we think you should be looking at this week, and we'll see you back next week on another episode.
Yep, see you soon.